The most dangerous moment in any financial system is not when prices crash, it is when prices stop telling the truth. Right now, if you look at the precious metals markets, you are seeing a comforting illusion of normalcy. You see tickers moving, charts fluctuating, and pundits talking about standard commodity cycles. They are wrong. What is happening beneath the surface is not a cycle. It is a seizure. We are witnessing the beginning of a structural divorce between the paper contracts that claim to represent value and the physical assets that actually possess it. This matters to you because this is not a niche trading issue. It is a stress test for the American superpower. The United States maintains its global leverage through the trust and transparency of its capital markets. When those markets become detached from reality, when they become managed fictions, we are not just losing money, we are losing the credibility that underpins the dollar itself. Over the next few minutes, we are going to strip away the noise. We are not going to talk about price targets or speculation. We are going to look directly at the broken mechanism of price discovery, the political chaos that prevents us from fixing it, and the very real cost of pretending this system is still sound. The volatility you see is not a warning of what might happen. It is evidence of what has already broken. You need to see this clearly. Let's begin. We tell ourselves comforting stories about the financial world because the alternative is simply too difficult to process. The most pervasive of these stories is the idea of normalcy. We look at charts, we look at tickers, and we tell ourselves that what we are seeing is standard operating procedure. Markets go up, markets go down. Volatility happens. It is the heartbeat of capitalism. When prices swing violently, we ascribe it to animal spirits, to fear, to greed, or to the natural ebb and flow of supply and demand. We assume, implicitly, that the machinery underneath is sound. But there are moments when that assumption becomes dangerous. There are moments when the volatility isn't a sign of a healthy market breathing, but of a broken market gasping. We are living through one of those moments right now, specifically in the metals markets. And I need you to put aside the usual explanations you hear on cable news or read in the financial press. They are selling you a narrative of just another commodity cycle. They are talking about inflation hedges and risk-off assets. They are talking about price. I am not interested in price. I am interested in mechanism. And the mechanism is breaking. Let's look at what has actually happened to the gold-to-silver ratio. For decades, this ratio has served as something of a geological and financial thermometer. It tells us not just about the relative value of two metals, but about the structural health of the monetary system itself. When the ratio moves, it usually drifts. It corrects. It creates trading opportunities for those paying attention. But recently, we didn't see a drift. We saw a compression so violent, so rapid, and so disconnected from traditional economic data that it defies standard analysis. We watched silver move with a ferocity that suggests something far more desperate than simple investor enthusiasm. The comfortable explanation is that this is retail speculation. We've seen that movie before, haven't we? The meme stock phenomenon applied to commodities. It's a convenient story. It allows serious institutional investors to dismiss the movement as noise, as the behavior of unsophisticated money chasing a shiny object. It allows regulators to shrug and say, caveat emptor, but that explanation fails under scrutiny. Retail investors do not have the capital depth to sustain the kind of backwardation. where the spot price eclipses the futures price, that we are beginning to see. Retail investors buy ETFs. They buy paper. They do not drain physical vaults in London and New York to the point where industrial users begin to get nervous. Something else is driving this. When you strip away the noise, what you are looking at is not a bull market in the traditional sense. A bull market implies optimism. A bull market implies growth. What we are seeing in the disconnect between gold and silver, and in the sheer violence of these moves, is a loss of faith in the delivery mechanism itself. Consider the asymmetry of the move. In a normal market, liquidity dampens volatility. When a price spikes, sellers step in, liquidity providers grease the gears, and the price discovers a new equilibrium. That is how price discovery is supposed to work. It is a negotiation. What we are witnessing now is not a negotiation. It is a seizure. We are seeing signs that the paper market, the vast, leveraged superstructure of futures contracts and derivatives that supposedly sets the price of metal, is losing its grip on the physical reality of the metal itself. When the gold-to-silver ratio compresses this quickly, it is signaling that the market views silver not just as a commodity, but as a critical, undervalued asset that must be secured now, regardless of the paper price. This is a structural warning. It is the engine light flashing red on the dashboard of the global financial system. Most people ignore it because the car is still moving. The S&P 500 is trading. The dollar is clearing transactions. The ATMs are working. So they ask, why does this matter? Who cares about the ratio between two rocks? You should care. You should care because precious metals are the canary in the coal mine for currency credibility. When that market stops behaving according to the rules of normal liquidity and normal volatility, it means the bedrock assumptions of the system are shifting. We are taught to view volatility as a measure of risk. If the price swings wildly, the asset is risky. But in this specific context, the volatility is actually a measure of truth. The price is trying to break free from a suppression mechanism that has held it in check for a very long time. The violence of the move is proportional to the energy required to suppress it. If this were just a supply shortage, we would see a smooth curve up. We would see miners ramping up production. We would see substitution effects. We aren't seeing a smooth adjustment. We are seeing spasms. These spasms indicate that the market is struggling to find the metal it claims to own. This brings us to the most uncomfortable realization of all. For years, we have operated under the belief that the price on the screen is the price of the asset. We believe that if the ticker says silver is X dollars, then you can buy silver for X dollars. We assume that the map is the territory. But what happens when the map and the territory diverge? What we are watching is the early stage of that divergence. The normal market is a lie we agree to believe in to facilitate commerce. But the physics of the market, the actual tons of metal in the vault versus the millions of paper ounces traded on the exchange, does not care about our agreements. It cares about math. And right now, the math is becoming hostile. So, as we move forward in this analysis, I need you to abandon the idea that we are discussing a trading opportunity. We are not talking about how to make 20% on a silver contract. We are talking about why the contract itself is becoming a fiction. We are talking about the difference between price movement and price discovery failure. Price movement is healthy. Price discovery failure is catastrophic. It means the market no longer knows what anything is worth because the mechanism for determining value has broken down. That is where we are. The gold-silver ratio didn't just move, it screamed. It told us that the era of easy, paper-managed stability is ending. The comfort of normal markets is gone. The volatility you see now is not a storm passing through, it is the climate changing. And we are not prepared for what that new climate looks like. To understand why this failure is occurring, you have to look directly at the machinery that generates the price. And you have to accept a premise that sounds absurd until you look at the ledger. The price of the metal has almost nothing to do with the metal itself. In a sane world, price would be determined by physical exchange. A miner digs it up, a refiner melts it down, and an industrialist or an investor buys it. Supply meets demand, and a price is born. That is not the world we live in. We live in a world where the price of silver and gold is set in the futures markets, primarily on the COMEX in New York and the OTC markets in London. These are markets built not for the exchange of physical goods, but for the management of risk and the transfer of cash. They are paper markets. In these markets, billions of ounces are traded daily. But here's the catch. Those ounces do not exist. They are paper silver. They are digital promises to deliver metal at a future date. Promises that are almost never kept because the contracts are settled in cash before delivery ever happens. This system works beautifully, provided nobody actually asks for the metal. It creates an environment where the supply of silver is theoretically infinite. If demand rises, the banks and liquidity providers don't need to find more physical bars. They simply issue more paper contracts. They sell short. They dilute the pool. They absorb the buying pressure with digital entries. This is known as tamping down volatility, but in reality, it is the artificial expansion of supply to cap price. For decades, this mechanism has allowed the financial system to divorce the paper price from the physical reality. It allows major institutions to rehypothecate, a polite banker's word for selling the same ounce of silver to multiple people simultaneously. In this game of musical chairs, there might be 100 claims for every one actual bar sitting in the vault. As long as the music plays, as long as investors are happy holding a paper receipt or an ETF share, the system appears efficient. It appears liquid. It appears normal. But look at what is happening now. The music is starting to skip. We are seeing a phenomenon called backwardation. In a healthy market with storage costs, the price of metal for future delivery should be higher than the price for immediate delivery. You pay for the privilege of waiting. You pay for the storage. But recently we have seen the opposite. We are seeing spot prices eclipse futures prices. This is a scream from the engine room. Backwardation means the market is saying, I do not want your promise. I do not trust your future delivery. I want the metal in my hand right now, and I will pay a premium to get it. It is a signal of extreme physical tightness that the paper market is desperate to ignore. While the digital price ticker might show weakness or stagnation, the physical premiums, the actual cash cost to secure a 1,000-ounce bar, are telling a completely different story. This exposes the core contradiction. We have a paper market designed for leverage and liquidity, colliding with a physical market defined by scarcity and logistical limits. You have to understand, this isn't fraud in the cinematic sense. There is no smoky room where villains are laughing while they steal your money. It is far more dangerous than that. It is institutionalized distortion. The major banks and clearinghouses are not suppressing prices just for profit. They are doing it for survival. They are the short sellers of last resort. If they stepped back and allowed the paper price to align with physical reality, the resulting explosion would vaporize the balance sheets of some of the world's most critical financial institutions. They are trapped in a position of their own making. They must sell more paper to keep the price down, but every paper ounce they sell increases the leverage, increases the risk, and widens the gap between the map and the territory. So the system tolerates the distortion. Regulators turn a blind eye to the leverage because the alternative, a chaotic unraveling of the paper trade, is unacceptable to them. They prefer the lie of stability to the chaos of correction. But here is the hard truth they are trying to postpone. The physical holders are winning. Slowly, quietly, the metal is leaving the registered vaults. It is moving from west to east. It is moving from public exchanges to private depositories. The paper market is still setting the price, yes, but it is setting the price for a shrinking pool of available assets. We are watching a system that survives only by postponing a reconciliation with reality. They are betting that they can manage the perception of value longer than you can hold out for the reality of value. But every day that backwardation persists, every day that physical inventory drains, the leverage becomes less of a tool and more of a bomb. The suppression is not a myth. But it is not a conspiracy of strength. It is a conspiracy of weakness. They are holding the beach ball underwater, and their arms are getting tired. The question isn't whether they want to let it go. The question is what happens when they no longer have the strength to hold it down. This is where the conversation usually stops. Most commentators treat this as a niche issue for gold bugs or high-frequency traders. They treat it as inside baseball. But I am telling you that if you care about the long-term viability of the United States as a global superpower, you cannot afford to view this as a niche issue. This is not about your portfolio. This is about the credibility of the American franchise. We have to widen the lens. We need to look at why the United States has been able to dictate the terms of the global economy for the last 80 years. It isn't just because we have 11 aircraft carriers. It is because we possess the world's reserve currency and, more importantly, the world's deepest, most trusted capital markets. The exorbitant privilege of the U.S. dollar rests on a single, fragile assumption: that American markets are transparent, that they are liquid, and that they honestly discover price. The world parks its wealth in New York because New York is supposed to be the one place where the rules are clear and the price is real. When we allow the paper manipulation of critical commodities to fester, we are taking a sledgehammer to that foundation. Think about what we established in the last segment. We have a system where paper leverage suppresses physical reality. When that happens, price signals die. And when price signals die, the market stops sending accurate information to the people in charge. This is a massive, underappreciated problem for the Federal Reserve and for U.S. monetary policy. The Federal Reserve claims to be data-dependent. They claim to steer the economy based on inflation expectations and market signals. But if the commodity markets, which are the early warning systems for inflation, are being artificially sedated by paper derivatives, the Fed is flying the plane with broken instruments. They look at the dashboard and see stability, while the engine is overheating. This is why they are consistently behind the curve. They are reacting to a managed fiction rather than a messy reality. And the cost of that blindness is exported to you. When the Fed misreads the market because the market is broken, we get policy errors. We get inflation that comes out of nowhere. We get sudden volatility shocks. We get a financial environment where the cost of living decouples from the official data. But the domestic cost is only half the story. The geopolitical cost is far higher. We are not the only ones watching these markets. Our adversaries are watching them too. And they are not confused by the paper game. They are exploiting it. Look at the behavior of central banks in the East, specifically China and Russia, and the broader BRICS coalition. They are not buying paper futures on the COMEX. They are buying physical tons, and they are doing it aggressively. Here is the strategic irony. By allowing our paper markets to suppress the price of gold and silver, we are effectively subsidizing our strategic rivals. We are keeping the price artificially low, allowing them to trade their trade surplus dollars for hard assets at a discount. We are selling the family silver to people who wish to dismantle our hegemony, and we are patting ourselves on the back for keeping volatility low while we do it. This is a transfer of strategic leverage from West to East, facilitated by the very financial institutions that are supposed to be the guardians of American capitalism. When the rest of the world sees that the London Metal Exchange or the COMEX can cancel trades or rewrite rules or decouple from physical reality, they lose faith in the dollar system. They start looking for alternatives. They start settling trade in local currencies. They start building parallel systems. We often hear about de-dollarization as if it is some distant theoretical threat. It is not theoretical. It is the logical market response to a price discovery mechanism that has become politicized and distorted. Trust is the only asset the United States cannot print, and we are burning it. If we continue to tolerate a market structure where the price is a lie, we are inviting a crisis of confidence that no amount of liquidity can fix. A superpower cannot maintain its standing if its markets are viewed as a casino where the house fixes the odds. This is an American problem. It is a national security problem. When the price of money and the price of commodities divorce from reality, the state loses the ability to measure its own health. We become a giant with brittle bones, strong on the surface, but rotting from the marrow out. We are mortgaging our future stability to maintain a facade of present calm. And the bill is coming due, not just in dollars, but in influence. The world is watching to see if we have the discipline to fix our own markets, or if we will continue to distort them until they break. Right now, the verdict is not looking good. We are choosing the comfort of the distortion, and in doing so, we are making the eventual reckoning not just a market event, but a geopolitical disaster. We are signaling that we no longer trust the free market to set the price, and if we don't trust it, why should anyone else? This brings us to the political dimension, and specifically, to the chaos of the current American political moment. You cannot discuss the erosion of institutional credibility without discussing the specific gravity of Donald Trump and the movement he leads. But we need to be very precise here. This is not about liking the man or hating the man. It is not about tweets or rallies. It is about governance capacity. There is a lazy narrative that says Trump is the cause of all this market dysfunction. That is false. The structural rot in the precious metals markets the addiction to leverage, the regulatory capture. This predates Donald Trump by decades. He did not invent fractional reserve banking. He did not invent rehypothecation. To blame him for the origin of the fire is intellectually dishonest. However, there is a second narrative that is equally dangerous. The belief that Trumpism is the cure. The belief that because he attacks institutions, he is somehow exposing the fraud and returning us to honest money. That is a fantasy. The reality is that Trump-style politics acts as a force multiplier for the very instability we have been discussing. It functions as an accelerant. To fix the broken price discovery mechanism in our markets, we need serious, disciplined, and boring regulatory reform. We need a surgical approach to unwind the leverage without blowing up the economy. We need institutions, the CFTC, the SEC, the Treasury, that are viewed as competent, neutral arbiters of the law. Trumpism makes that impossible. The core tactic of this political brand is the systematic delegitimization of institutions. It frames every regulator, every central banker, and every civil servant not as a technocrat trying to keep the lights on, but as an enemy of the people. It treats complexity as a conspiracy. When you spend years telling the public that the system is rigged, not in a technical sense, but in a cinematic, deep state sense, you destroy the political capital required to actually fix the rigging. Think about the consequences. If a regulator today tried to intervene in the silver market to enforce position limits and break the paper stranglehold, half the country would view it as a necessary reform, and the other half, primed by years of anti-institutional rhetoric, would view it as an attack on their guys or a manipulation by the swamp. Everything becomes a culture war. Mathematics becomes partisan. This paralysis is exactly what the beneficiaries of the current broken system rely on. The banks and the clearinghouses love the chaos. They love the noise. As long as the public is distracted by the political circus, fighting over narratives and personalities, nobody is paying attention to the plumbing. Trumpism sucks the oxygen out of the room. It converts real structural problems, like the disconnect between paper and physical assets, into narrative chaos. It prevents coherent response, and this leads to a terrifying vulnerability. We are facing a complex technical crisis that requires a steady hand. Instead, we have a political culture that rewards burning down the house to flush out the rats. Our adversaries understand this better than we do. When China looks at the United States today, they do not see a superpower strictly debating monetary policy. They see a superpower at war with its own nervous system. They see a country where the political leadership is actively dismantling trust in the very institutions that underpin the dollar. They know that if a true liquidity crisis hits, if the backwardation in gold and silver breaks the paper market, the United States lacks the political unity to respond effectively. We are too busy fighting each other to save the ship. So, do not make the mistake of thinking that draining the swamp helps price discovery. It does not. It muddies the water so thoroughly that nobody can see the bottom. Trumpism doesn't expose the fraud. It insulates it. It creates a fog of war where the actual looters, the ones benefiting from the paper price suppression, can operate with impunity, knowing that any attempt to stop them will be drowned out by the screaming match in Washington. We are left with a tragedy. We have a system that is technically broken and a political environment that is incapable of repair. We have replaced competence with combat. And in the financial markets, combat is not a strategy. It is a suicide pact. The system is screaming for a surgeon. We sent in a demolition crew. And we are about to find out that you cannot rebuild trust with a wrecking ball.